After that meeting, I don't think we got a lot of answers, and I think there's a lot of questions. After what you heard, knowing there's a meeting on Friday, what is your biggest question and biggest takeaway from yesterday's meeting?
That we're in a holding pattern. The word you used was stalemate, and that there's far too much complacency in the markets about politicians doing the right thing at the last second, which is what investors are used to.
Yeah, I mean, certainly seems like it's going to come down to the very last minute here. Ahead of this meeting on Friday, if you were to advise companies and as I mentioned, corporate boards that you did at Citi and as you do now with your own company, what would you tell them about the risk of this debt limit? I mean, most people think there's going to be some resolution, but in the meantime, where's the risk?
I think it's twofold. First of all, investors are right based on the historic resolutions of this, this drama, this very particularly American drama around the debt ceiling, which is it's a game of chicken. And just like James Dean in Rebel Without a Cause, we go right to the edge. And then there's a just-in-time solution. But you have to look at what's different in the context. What's different in the macro context, first of all, is that we have some other serious risks in the mix, meaning the banking sector wobbles, the U.S. regional banks, obviously the war in Ukraine as a geopolitical risk. And when you look at the convergence of this constellation of risks, I would argue there isn't much room, as we might have seen in previous instances of debt ceiling drama, for a policy error, a miscalculation, or frankly, just playing fast and loose.
All right, so you're saying there's a constellation of risk. You also call this the poly-crisis era. Neither one of those sound very good, Tina. I want to focus on investors for a minute. How seriously should investors take the risk of a default, and what should they do in response to that risk?
Well, I've explained that I think they should take it seriously. People like to put probabilities on this stuff, and it's difficult to do that econometrically. But let's say that there is a material probability of at least a short-term default. That could be around 20%. 20% probability events happen in real life all the time. So the first thing is stress test your portfolios against even a whisker of a run-in with the debt ceiling, because that is more likely now than at any time since 2011, when we were looking at these circumstances before. Also, this isn't just a binary outcome. Will they or won't they allow a default? Even the way in which these negotiations are handled sends a signal to the world, which is looking for and at U.S. leadership, and also talking a lot more about de-dollarization than in the past. This is a built-in advantage that the U.S. has that just shouldn't be squandered easily. So interim scenarios between default and last-minute resolution are also worth bearing in mind.
So, Tina, one last question. A lot of people are comparing this to 2011. Is this just like 2011? And if it's not, what's the biggest difference, especially for investors?
I think the biggest difference compared to 2011, apart from size of majority and these kind of technical aspects, is just the Cavalier attitude that we're hearing from members of Congress. To be a voice of reason doesn't get you elected these days, and to be a person who forges compromise is also not something that is seen as a helpful asset heading into yet another election season. So I worry that we're in a real period of kamikaze politics, and markets will pay the price.